The financial markets, in their relentless evolution, may transform in appearance. Technology advances, new instruments emerge, and the speed of transactions accelerates to unimaginable velocities. Yet, beneath this ever-changing surface, the fundamental drivers of market behavior, human psychology, and the immutable laws of supply and demand remain constant. It is this unchanging core that ensures the enduring relevance of the wisdom distilled by legendary figures such as Jesse Livermore. While many modern traders obsess over novel indicators and ephemeral strategies, the seasoned professional understands that true, lasting success on the exchanges stems from adhering to timeless principles, forged in the crucible of experience. Subscribe now, leave a like, and write any comment. This way, you'll help more people see and hear this message, and I'll know that my work is not in vain. Jesse Livermore, a man who built and lost fortunes multiple times over the course of his tumultuous career, was not merely a speculator, he was a profound observer of the market and human nature. His insights were born from the painful lessons of direct engagement, from the thrill of immense triumphs to the despair of crushing bankruptcies. He understood that the market, in its essence, is a reflection of collective human emotion, a grand stage where greed, fear, hope, and pride play out their eternal drama. It is this deep psychological understanding, coupled with a disciplined approach to reading price action, that formed the bedrock of his unparalleled success. Livermore's teachings are not historical curiosities. They are battle-hardened rules, principles tested and proven across various market cycles, bull markets, and devastating crashes. They speak to the universal truths of speculation that transcend the specific instruments being traded or the speed at which they move. His genius lay not in predicting every tick, but in recognizing critical junctures, in discerning the market's true character, and in responding with unwavering discipline. Many who enter the speculative arena today fall prey to the same emotional pitfalls and strategic missteps that plagued traders a century ago. They seek shortcuts, chase fleeting trends, and ignore the fundamental tenets of risk management and self-control. This pursuit of novelty often comes at the expense of mastering the foundational rules that truly dictate long-term profitability. Livermore's rules offer a sobering, yet incredibly empowering, counter-narrative to the prevailing noise, guiding traders back to the core principles of sound speculation. Therefore, this exploration will delve into 15 essential rules that Jesse Livermore would undoubtedly employ if he were trading in today's markets. These are not mere suggestions, they are the distilled wisdom of a master, paid for with millions, and offered as a timeless guide for anyone serious about navigating the complex and unforgiving world of financial speculation. Embracing these principles is not about replicating Livermore's exact trades, but about adopting the unshakable mindset and disciplined approach that allowed him to achieve legendary status. At the very forefront of Jesse Livermore's enduring philosophy, overriding all other considerations, was the paramount importance of capital preservation. He understood, often through the bitter experience of financial ruin, that the first and most critical objective of any speculator is to protect their trading capital. Without capital, the game ends. All strategies, all insights, all desires for profit become utterly meaningless if the very fuel for speculation is allowed to evaporate. This rule is simple in concept, yet shockingly difficult for many to internalize, leading to the premature demise of countless trading careers. This leads directly to Rule 2. Always use a stop-loss. Livermore considered a stop-loss order not as an admission of defeat, but as an indispensable insurance policy. Before entering any trade, he insisted on clearly defining the point at which he would exit the position, accepting a predefined, small loss to prevent a potentially catastrophic one. He viewed these small losses as the tuition for staying in the game, an unavoidable cost of doing business. The failure to honor a stop-loss, to allow a small mistake to become a devastating error due to hope or pride, was, in his view, a cardinal sin in speculation. Rule 3. Never average down. This was perhaps one of Livermore's most emphatic and hard-won prohibitions. Averaging down involves buying more shares of a security that has fallen in price, hoping to lower the average cost and profit when it eventually rebounds. Livermore unequivocally condemned this practice, stating that it was a desperate gamble that invariably magnified losses. He understood that adding to a losing position was a sign of a flawed initial judgment and a dangerous refusal to admit error. His maxim was clear: average profits, never average losses. Furthermore, Livermore adhered to Rule 4, control your position size. He understood that no single trade, no matter how promising, should ever jeopardize a significant portion of one's total capital. Over-leveraging or risking too much on one venture exposes the speculator to the inevitable vagaries of the market and the inherent unpredictability of even the best analyses. A prudent speculator sizes their positions defensively, ensuring that even a series of small losses, if they occur, do not cripple their overall trading ability or psychological fortitude. Finally, Rounding out this critical block of capital preservation rules is Rule 5. Admit mistakes quickly. Pride, ego, and the human reluctance to be proven wrong are deadly flaws in speculation. Livermore learned that clinging to a losing position, stubbornly convinced that one's initial analysis must eventually prove correct, was a sure path to ruin. The market does not care about one's ego. The ability to recognize an error swiftly, cut the loss, and move on to the next opportunity is a hallmark of the disciplined professional. This humility in the face of market judgment is paramount for long-term survival. Beyond the mechanics of capital preservation, Jesse Livermore understood that true market mastery was inextricably linked to psychological discipline and a profound ability to read the market's true language. His rules in this domain directly confront the inherent human biases that plague most speculators. Rule 6. The market is never wrong. This was a fundamental axiom for Livermore. He believed that while a speculator's opinion might be incorrect, or their analysis flawed, the market's price action itself was the ultimate truth. Attempting to argue with the market, to hold on to a position based on a preconceived notion that contradicts what prices are actually doing, was a guaranteed path to financial ruin. This leads to the crucial Rule 7. Control your emotions. Livermore consistently emphasized that the greatest enemies of the speculator are not external market forces but internal psychological demons: fear, greed, hope, and pride. Fear causes premature selling, while greed leads to overstaying profitable positions. Hope encourages holding losing trades, and pride prevents admitting mistakes. Livermore viewed the market as a constant test of character, where emotional detachment and cold, hard logic were far more valuable than raw intelligence or intricate strategies. He learned that mastering oneself was the prerequisite to mastering the market. Closely related to this is Rule 8. Disregard the psychology of the crowd. Livermore often observed that the general public, the collective crowd, was almost always wrong at the crucial turning points of the market. They are most enthusiastic at the top and most despairing at the bottom, buying high and selling low. Succumbing to popular opinion, acting on rumors, or following the hot tips circulating among the masses was, in his view, a recipe for disaster. The successful speculator must cultivate independent thought, a willingness to be lonely, and the courage to go against the prevailing sentiment when their own disciplined analysis dictates it. To truly understand the market, Livermore advocated for Rule 9. Read the market by its own signals. He believed that the market always spoke its intentions through its own language of price and volume action, if one was disciplined enough to listen. Rather than relying on external news, opinions, or complicated indicators, he focused on the raw data of how prices moved, how they reacted to certain levels, and the volume accompanying those movements. He looked for patterns of accumulation or distribution, for signs of strength or weakness, directly from the market's behavior itself. This deep reading of market signals culminated in Rule 10. Trade at key points. Livermore did not believe in constant trading or predicting every minor fluctuation. Instead, he sought out key points, critical price levels where a stock or the market confirmed its direction, signaling that the line of least resistance had become clear. These were the only times he would commit significant capital. Entering at such points minimized risk and maximized potential profit, as the market itself was validating the move. This selective and patient approach to entry was a hallmark of his disciplined methodology. Subscribe now, leave a like, and write any comment. This way, you'll help more people see and hear this message, and I'll know that my work is not in vain. Beyond the foundational principles of capital control and psychological mastery, Jesse Livermore's wisdom extended to the strategic execution of trades, demanding patience and highly selective thinking. These elements are crucial for avoiding the common pitfalls of overtrading and succumbing to boredom or impatience. Rule 11. Great money is made in the major moves. Livermore repeatedly emphasized that true wealth is not accumulated by scalping small profits or attempting to capture every minor fluctuation. Instead, it is the result of identifying and patiently riding the significant, long-term trends. His focus was always on the big money, which lay in the major upward or downward swings of the market, not in the day-to-day noise. This conviction directly informed Rule 12. Do not trade every day. Many amateur traders feel compelled to be constantly active, believing that sitting idly means missing opportunities. Livermore strongly countered this, arguing that most of the time, the wise speculator should be doing nothing at all. He understood that truly profitable opportunities, those that present themselves at key points with clear direction, are rare. Therefore, patience and the discipline to wait for these undeniable setups, rather than forcing trades out of boredom or a desire for constant engagement, were paramount. Conserving capital and mental energy during periods of uncertainty was a key to his success. Complementing the desire to ride major moves, Livermore articulated Rule 13, let your profits run. This stood in stark contrast to the common tendency of cutting profits short, where traders exit winning positions prematurely out of fear that gains might evaporate. He believed that once a trade was initiated correctly, and the market confirmed its direction, the speculator's job was to hold on as long as the trend persisted. He famously stated that you could be right 2 out of 5 times and still make millions, if you let your profits run on your winning trades and cut your losses quickly on your losing ones. Greed, in this context, was about not letting profits grow. Livermore also advised Rule 14, do nothing when you are unsure. This reinforces the emphasis on selective engagement and avoiding unnecessary risk. If a speculator felt confused by the market's action, or if a clear key point was not present, Livermore would simply stay out. He understood that capital is earned during periods of clarity and patience, not by forcing trades when the outlook is ambiguous. It was far better to miss a potential opportunity than to enter a trade based on guesswork or a desire for action, risking capital unnecessarily. Finally, underpinning all execution and decision-making was Rule 15, keep a detailed trading journal. While not a direct trading rule about market entry or exit, this practice was fundamental to Livermore's continuous learning and adaptation. He meticulously recorded every trade, the entry, the exit, the rationale, the psychological state, and the outcome. This objective record allowed him to analyze his mistakes dispassionately, identify recurring pitfalls, and refine his rules and approaches. He understood that self-analysis through documented experience was the most invaluable teacher in the unforgiving school of speculation. The principles laid down by Jesse Livermore a century ago remain remarkably, indeed eternally relevant in the tumultuous financial markets of today. While the platforms have changed, the speed of information has accelerated, and new instruments have emerged, the core dynamics of human behavior and the fundamental laws of supply and demand are constant. His rules, therefore, are not historical footnotes, but living commandments for anyone seeking consistent and enduring success in speculation. They remind us that true market mastery is not found in complex algorithms or secret indicators, but in the unwavering application of discipline, patience, and independent thought. Livermore's profound insights into market psychology, risk management, and the art of selective action transcend any particular technological era. Whether trading stocks, commodities, or modern derivatives, the human tendencies toward greed, fear, hope, and pride remain the speculator's greatest adversaries. His emphasis on cutting losses, letting profits run, and waiting for clear signals addresses these timeless psychological pitfalls directly. He understood that the market is designed to humble the arrogant and reward the disciplined, a truth that holds firm regardless of the prevailing market conditions. The path to becoming a successful speculator, as illuminated by Livermore, is a continuous journey of self-mastery and relentless learning. It demands a willingness to be wrong, to admit mistakes swiftly, and to extract valuable lessons from every setback. His insistence on reading the market's own signals, rather than being swayed by external noise or popular opinion, underscores the paramount importance of independent thinking. In a world saturated with information and contradictory advice, the ability to filter out the irrelevant and focus on objective price action is more crucial than ever. Livermore's rules serve as a powerful antidote to the common maladies of modern trading: overtrading, impulsive decision-making, and the pursuit of instant gratification. They preach the virtue of patience, the power of inaction, and the wisdom of waiting for truly opportune moments. They teach that real money is made not by constant activity, but by strategic, well-timed participation in the major moves, and by the disciplined protection of one's hard-won capital. Ultimately, these 15 rules are more than mere advice. They are the solemn testament of a master speculator, written in the indelible ink of millions earned and lost, for the benefit of those who aspire to true and lasting success. They represent a timeless blueprint for navigating the volatile seas of the market, guided by the twin stars of discipline and unwavering realism. For those willing to embrace these principles, the promise of sustained profitability and profound financial understanding remains as vibrant today as it was in Jesse Livermore's own legendary time. Subscribe now, leave a like, and write any comment. This way, you'll help more people see and hear this message, and I'll know that my work is not in vain.